I still don't know a ton about this. I honestly learned about this guy's existence yesterday as I'm watching someone cover it at CNBC. And I'm like, what are they talking about? And then I start Googling and I was like, what? Like, who? Why?
So this is Situational Awareness, a hedge fund and manifesto that was written by a 24-year-old hedge fund king.
Well, a 22-year-old at 22. The time.
His name is Leopold Aschenbrenner. And what this guy was basically able to do is get billions of dollars to go into his hedge fund. And then it appears he started making a lot of leveraged bets on things like SK Hynix, shorting old school software makers. And then the entire thing blew up and he had to sell, was it about $10 billion worth of just publicly traded stocks to Ken Griffin on Wall Street.
And also the other side of it is people are now blaming Ken Griffin and saying he and his team had been posting unflattering comments online designed to help push down the shares of some of the companies that he's invested in so that they could swoop in and buy it for parts. It's fascinating. The internet is a fascinating place.
That is beyond petty. That is beyond a pet. You think people writing unflattering comments can just push down the values of near $1 trillion companies, in some cases above $1 trillion, just to push down the shares of a single hedge fund so you can swoop in on their leveraged bets?
Well, I would say two things. One, Ken Griffin's no lightweight. When he speaks, investors and analysts and the markets listen. So not impossible. There's a non-zero chance. And then two, Ken Griffin is a hedge fund manager who is a very shrewd markets participant and watcher. So again, a non-0% chance that this is possible. But I agree with you where I think you were going, that it is very far-fetched to assume that even if he had that kind of malice in his heart, that he would be capable of pulling off something so perfectly diabolical.
Unfortunately, this is the time where people start dredging up things you've written, things you've said on a podcast.
Mm-hmm.
Unfortunately for Leopold, this is what he told Dwarkesh Patel in a 4-hour podcast interview. Quote, "We're going to have more situational awareness than any of the people who manage money in New York. We're definitely going to do great on investing, but it's the same sort of situational awareness that is going to be important for understanding what's happening, being a voice of reason publicly, and being able to be in a position to advise. Not only am I a person of wisdom, Malcolm, but I am smarter than anyone who manages money on Wall Street in New York."
I am smarter. Me and my computer are smarter than any of you. Yeah.
This is one of those things where it's usually a bad idea to convince yourself you're a great man of history at any point in your life, but especially in your 20s. The Charlie Munger quote is being brought out that smart people go broke for 3 reasons: liquor, ladies, and leverage. This is a case where the third reason is why he is appearing to go broke. But as I was going through this guy's manifesto, which, let me pause right here. Malcolm, bullish, bearish, neutral on manifestos, which are making a comeback in the AI world.
Am I bullish, bearish, or neutral? I would say I am probably neutral as a person who writes sometimes for my own blog to get some of my ideas out of my brain and onto paper. And so I publish them publicly, one, so that I can look backward and say, hey, look at that, I'm a genius, I was right. Like I wrote something about data centers being more valuable than microchips like 3 years ago. And it probably seemed like nonsense or maybe nothing to even click on back then. And now in hindsight, made perfect sense. So I think there is something to that. But when you write a manifesto that's 25 pages and so lofty and pompous that it can only be seen as advertising or a political campaign, then I think you set yourself up for failure.
There's been a rebrand for manifestos. Manifestos used to be, which by the way, you're not writing manifestos, you're writing blogs. You're talking about like what tech employees should consider tax-wise when they are granted restricted stock units. That's very different from saying the United States will need a 2-year advantage over China in terms of super intelligence capabilities so they can come to us and we can tell them what's up. But this guy's Leopold's manifesto, right, says, quote, sure, going all in leveraged long on NVIDIA in early 2023 has been great and all, but the burdens of history are heavy. I would not choose this. Have you ever seen a worse two sentences that made you dislike someone more outside of like, you know, actual like hateful comments? Set that aside. Just someone finding a way to be a sniveling jerk in 2 sentences. Is there anything better than this?
Here's the thing, though. Is he able to raise $20 billion if he isn't a contrarian, pompous jerk who gets people's attention and makes people say, yeah, I want to line up behind that guy, right? It's the Elon Musk playbook.
Totally fair. It's also
like, can Elon Musk raise the value of SpaceX by 12 times in the course of, 18 months if he's not making these wild, bombastic statements publicly?
We got to start wearing turtlenecks. We got to start saying more far out stuff and wearing turtlenecks.
If you ever see me out of my house wearing a turtleneck,
yeah,
you should call my wife and tell her to start making arrangements because I am very close to the end. Like, there's no world in which you will see this neck turtle, okay?
There's a part of this where I want to dunk on this guy, right? Like, you're like, yeah, you lost your hedge fund and you're dumb. But what we've seen from this time and time again is people like this, like, they'll be fine. Like, this guy will be all right. He still has his private stakes in Anthropic. Hear me out. Do you remember WeWork guy, Adam Newman?
Yeah, that's
Adam
literally who I was about to point out.
Adam Newman falls through 18 floors as WeWork goes bust. He's doing, what is it? He's taking tequila shots on private jets while his company is going bankrupt.
Yeah.
There's some allegation stuff that you don't want to get into. And then for his next project,
he walks away with $100 trillion buyout.
And he gets funding. He gets funding from A16Z for his next project. Because they're like, yeah, we want people.
Does Masayoshi Son fund his next thing?
This guy?
That's the round
Leopold?
trip. Yeah. That's the real round trip.
Is Masa-san a hedge fund guy, though?
Masa-san is a strategic investor wherever he needs to be. I don't think that there is a technical mandate. They have like a go anywhere, do anything kind of mandate to, SoftBank's shares. Because they got like 4 different funds, too, that he's managing from. And so, yes, he had the burn all boats moment where he threw all of the weight of the company behind OpenAI. But I think they've been able to raise additional capital since then. And so now he could come find this guy, this Leopold guy, and say, hey, look, you crapped out on your first hand, but I believe in you. So let's go do this thing together.
Yeah, I mean, the guy, his hedge fund was up, 450 something % in 1 year.
Yeah.
So even though the thing blows up, you're going to have investors saying like, well, at least you pulled that off, and maybe I'll just be more careful with my capital and make sure I can put some in, take some out every 3 to 6 months if you want to run this again.
So I'm going to say one thing, though, that in all seriousness, and I know this is like we're having a serious discussion anyway, but in all seriousness, what I am seeing and concerned about as it relates to this is that so many people who don't have experience with investment cycles are operating on leverage, and they shouldn't be, because they don't actually understand the mechanics of what an unwind looks like and how fast it hits you. So he's making all these leverage bets and attracting all this attention. A hedge fund that's up 400% in 1 year is going to attract attention. It's also going to attract follow-on investors. And so what ultimately happens is everybody's consolidating into these same trades that are working well for you. and crowding into the same party, which then means that the share price goes up even further and up even further and up even further. So the leverage gets larger and larger and also more expensive because margin costs money. So then the cost of the margin eats into your returns. And if you have a down day, now you've got the cost of the leverage plus you just fell below a certain marker where your broker is saying, hey, listen, like we're cutting it too close. You need to sell something to raise cash to pay off the margin. So if you have too many down days in a row, which all of the semiconductor stocks have recently, which is what brought this house of cards down on top of itself, that's where you get crushed. But by the time you realize it's happening, you haven't gotten enough liquidity to close your positions and get out of the way. And so for the average person who's following this and trying to do it with the 2X bull levered SK Hynix ETF or the 3X bull levered SOX L ETF, all buying the exact same semiconductor stocks using the exact same leverage, it's so fast, the cascading effect of this, that average ordinary people trying to do this too are getting crushed, just not in such spectacular fashion that we all see it play out online.
Well, the key to what you're describing there is the ordinary people on the other side. The people in this hedge fund, they're going to be accredited investors. They're going to be... this isn't like a Bernie Madoff thing where it's a bunch of people lost their retirement savings because of fraud, right? People are going to lose money. It's going to be painful. But I think the rich people that were buying into this hopefully knew that there was an insane amount of risk that they were taking in this. And then for the side of Leopold, he said to a friend, this is according to The Verge, Leopold said to a friend, quote, either AGI happens this decade and my human capital depreciates, but I turn it into financial capital, or no AGI happens and the firm doesn't do well, but I'm still in my 20s and smart.
Hey, I mean, if that is verbatim what he told that friend, looking at what has happened with Adam Newman's career and the fact that he's still hanging out, around the backboard, just waiting for a rebound, I think there's some there. From what I understand, the guy's getting married this weekend. Like he's off into the sunset, living his best life.
To Anthropic's chief of staff. The rest of the show, we're going to be talking more about risk. Risk is kind of the theme of this show. I want to bring in a free solo rock climber into how we talk about financial risk. We'll see if we can tie that together. Malcolm briefly mentioned how regular investors are seeing unwinds happen quickly. That's exactly what has happened in South Korea. More stories coming out about that may or may not parallel what's happening in the United States. And then if we can get to this, if we have time, the AI proliferation of chat phishing, which is where people are using chatbots to write their responses on dating apps. It's a real problem. So let's get into the rest of it.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
So the leverage story in the beginning, United States. This is South Korea. We'll see if it comes back to the United States, though. Here's the context. Leveraged ETFs. And when we say a leveraged ETF, that means you want to get 2x, maybe even 3x the daily movements of a single stock. So this goes great when Micron technology is running up and up and up. And then instead of a 10% day, you have a 30% day. But things can fall apart quickly. So these leveraged ETFs are new in South Korea. And they start trading on SK Hynix and Samsung, which make memory chips that investors really, really like right now and are extremely popular. They start trading May 27 of this year. So what is that, 2 months ago? About 2 months ago. According to Morgan Stanley, by June 22nd, those single stock levered ETFs were 20% of the average daily trading volume for this for the Kospi, which is the South Korean stock exchange. So these things take out like absolute wildfire. And then almost simultaneously to these products coming out, that's when investors start beginning to turn just a little bit on the memory trade. The South Korean stock index, it's down about 32% since these products came out, but it's down 40% since its June peak, which is a deep, deep bear market. People who've been invested in a while for those companies in the index, they're still up, they're okay. But a lot of people that got burned on this are those making these leveraged stock bets, talking about what their day trades are in group chats. And that's where things get dangerous.
Well, so what I don't understand, I shouldn't say I don't understand. I am not a person who is this risk on. I consider myself to be a pretty risk tolerant person, especially when it comes to investing. What I don't understand, though, is like Micron, for example, is up about 200% year to date. Why isn't that enough? Why do I need a 2x levered ETF to juice Micron for me instead of just holding it long and taking that ride?
So we talk about risk tolerance and risk capacity, which is concepts we'll get into more. But I think there needs to be a third access for desperation. People feel like you're speaking in a rational way. Maybe I've already seen Micron go up 200% in a few months, but I'm thinking about, am I going to be able to afford a vacation or even rent or even like steak at the grocery store? And this seems to be a way to get out of my financial mess. I've seen people in chat rooms do it. I've seen maybe a couple of friends do it. And so therefore, I want to get in on this while the getting's good. I'm not thinking about risk necessarily. I'm thinking more about survival, which then leads someone to take an extraordinary amount of risk.
However,
I wasn't justifying it, by the way.
No, I'm with you. You're giving me the other side of it. I'm just thinking like, I don't know who is most responsible for, but there's this saying in rap music, don't go gambling your rent money, right? Excuse me. And this exactly what you're talking about. Like my ability or inability to take a vacation this year is tied to whether a 2x levered bet on a semiconductor company pays off for me or not. How absurd is that? Like what that tells me, if that is actually your circumstance, you have no business going on the vacation in the first place. And I don't mean to sound like a finger waggy old man saying that to whoever's listening to this that applies to and it just cut you deep. But I mean it literally. Like if your entire ability to go on this vacation is tied to MU, then you have no business going on that vacation at this moment because you don't have enough room for something to go wrong. Like
baby step one, Dave. Thanks, Dave Ramsey.
But you know what I'm saying? Like if that is the case, or I hear the argument of like, this is how I'm going to buy my house. And then the people who own a house, you hear about taking out home equity loans that push them above the value of the property. So now they got a negative equity situation so that they can put the cash from the home equity loan into the market and buy a levered ETF. So now I got leverage on leverage on leverage on an asset that I did everything I could to be able to buy in the first place.
Okay, you're talking about that like it's a trend. I have heard of no one taking out
no, that's not
equity loan.
No, that's not off the top of my head. That's a real ETF. So I have seen, I don't know, maybe 10 documentaries on Bitcoin, for example. Okay. I've seen like 10 documentaries on the GameStop craze and Robinhood during the early days of the pandemic and everything else. And every single time there's an interview with some dude, it's usually a young dude, who managed to buy a house and then is crazy enough to leverage the house to buy stock in GameStop or whatever and bet the house literally on this one thing.
I'm glad that we are getting to the actual thing you had heard of, because it was a little bit like, it would be like me saying, like, there's just, as a general trend, there's a lot of ugly and mean women in San Antonio, Texas. And that's just, what a lot of people out there say. And that's just kind of a general thing that a lot of people know. It has nothing to do.
I've never been to San Antonio, but if that's what you're telling me the trend is, I'm inclined to go with it, because what do I know?
I've never been. That was a joke. Respect to our listeners in San Antonio.
No, but I mean, literally, like, as I'm saying this to you, that is such a far-fetched example that why wouldn't you believe me that it just has to be a thing? Because,
So with SK Hynix too, which, by the way, as we record, is up 30% today on Friday morning.
Today. Like
one morning.
Yeah. Microsoft was up 15% after it posted their earnings, and that was the best single day move Microsoft has had since 2008. So coming out of a financial crisis, Microsoft has, this gigantic move that sets a record for them. It was almost 20 years later before they had a 15% move in one day. And this is one of the most valuable companies in the world. We're talking about SK Hynix having a 30% move in a single day. That is absurd.
And so that was also from me trying to check the stock chart for like a month as I was about to make another point. And I was like, whoa, it's up 30% in one day. Live reaction. That's why Malcolm's good on CNBC. So the point that I wanted to make with this, though, is SK Hynix reported earnings, and they said that our revenue is up 51% from quarter on quarter, not year on year, just from the last quarter. For this mature memory company, we're making 50% more money, more than 50% more money than we did last quarter. And the thing still blows up because of expectations and leverage. There's a lot of like, the Wall Street people like to say, oh, we're constantly looking forward, and that's why stock prices move. In this case, I think it's just people started getting a little scared. It is totally disconnected from the business.
Oh, yeah. The earnings have nothing to do with this. Absolutely nothing. If they did, NVIDIA wouldn't be down while the rest of the semiconductor index is up, because they've got 80+% gross margins on their business. They've got the most productive company, like revenue per employee, and nobody cares at this moment. They're like, shut up, NVIDIA. Stop telling us about your company. We want to buy Micron. We want to buy AMD. So if the earnings actually mattered, like you're talking about, it wouldn't even be close.
Yeah. With that, does that make any of the memory? Does this story and unwinding of desperate sellers make any part of the memory trade interesting to you right now, or are you still trying to hide out?
I think the memory trade has left that horse has left the barn. I think anybody trying to chase it at this point is setting themselves up for failure. So Apple reported earnings. From what I can tell, they're getting beat up because they mentioned the memory shortage costing more money. They've got to raise prices for each handset going forward, because now the input costs have gone up because all you people bought up all the memory, right? But what's going to happen when we no longer need the amount of memory that we once did, and all these companies that are reporting that they're building additional facilities to meet the demand of today finally bring those facilities online 2, 3, 4 years down the road? Well, then the cost of all that memory they built, that oversupply, is going to come down ridiculously. And who's going to benefit from that other than one of the biggest bulk purchasers there are out there of memory chips, Apple? So Apple's going to raise the prices on the handset. So we're going to go from $1,000 to $5,000. And then they're also going to see their input costs go down dramatically within the next year, because all these companies overbuilt and everybody's lining up and begging Apple to take their oversupply so that they can get rid of all this inventory. So there's the setup trade. To me, the memory trade is done.
Yeah. Okay. Good note. Last show, I asked our listeners if they liked, we do a mix of topics on this show. We do some fun stuff that relates to economics and finance, and then we do some of the more in-depth market coverage. And one of the things I asked listeners to write in is, do you like the mix? Do you want us to go in one direction or the other direction? And that was the most reaction we got from a question I've sent to listeners, Malcolm. Because at the end of the day, you and I are essentially massage therapists. And so we got to ask if the pressure is too much. How much pressure? Too much pressure, too little pressure. But in this case, when you ask a bunch of different people, the pressure tolerance is different. So we do a mix. I'm going to try to bring this to a story that I will relate to finance and risk, which is my latest obsession. It's called The Dark Wizard on HBO Max. And it is the story of a free solo climber and daredevil. His name was Dean Potter. And it's very much about risk, and why we stay around dangerous people, I think, is the undercurrent of this story. And this guy would climb up cliffs without a harness, and then he would occasionally do slacklining, which is where you have basically a tightrope that wobbles and bounces. And he would do that from cliff to cliff, 1,000 feet off the ground, often without a safety harness or a net. One of the ways he managed risk in the case of free solo climbing was something he called free basing, which is I'm not going to attach a rope to my back. However, I will attach a parachute. So if I need to nope out on this climb, I don't die. I will just, fly down for a little bit and have the parachute take care of me. Of course, there's still an insane amount of risk in that because you still have to get your body off of the cliff enough that the parachute operates. But as I was watching this, Malcolm, I was thinking there are people who clearly have the part of your brain that experiences risk totally removed. And I think it's one of those things that happens slowly and then all at once. So my first question on this, before I keep ranting, is did you get a chance to check this out? Or are you out on like free solo climbing documentaries?
No. So as you were talking just now, you may have noticed that I was looking down at my phone. I wasn't ordering Uber Eats. I was adding this to my watch list because you told me about it before and I forgot all about it. And I meant to check it out. But then I'm looking at the pictures that like the thumbnail photos on HBO's, app. And this dude is like out of central casting for a free solo climber. Yeah. Like, why does he have to wear the homemade burlap pants and nothing else to climb in? Like, now I'm immediately dismissive of the whole thing because I feel like he's like cosplaying a character of a person who would do this, not the person who would do this. And I know that has nothing to do with anything. I'm still going to watch it, but that's the first thing that jumped out to me.
You sound like you're like a rival free solo climber, by the way, where you're like, I could do half dome without a rope in much less time. Minor spoilers.
No, I'm just a guy who judges books by their cover.
Fair enough. Minor spoilers ahead. There is a part of this where Alex Honnold, who is the climber who did the free solo documentary, he was the subject of that. They had a bit of a rivalry. And when Alex was discussing the free basing strategy, which is an interesting strategy to call your whatever you're doing, free solo climbing with a parachute, he essentially called him a circus performer, which is a huge insult in that world. Like,
it is and it isn't, because like Harry Houdini had rivals, and I can't tell you any of their names. They referred to him as a hey, look at me, or in online parlance, a pick me. And we know his name. We don't know theirs.
Harry Houdini rivals?
Yeah, like there were rival magicians that were like, he's not a purist. He's not doing it for the love of the game. He's a circus performer. And yeah, okay.
Okay, well, both of these guys are. If you climb up Half Dome without a rope, you more so than taking a leveraged bet on Nvidia, I think you get to be famous for your risk tolerance.
So I think that's the more important point you were trying to make, and I distracted us with talking about making an elephant disappear in the middle.
You did. I didn't bring up magic this time. This is the first time on the show.
I just said I distracted us,
I'm not
sir.
Defensive. You're defensive.
Yeah, right, clearly. But I was saying you were making a bigger point about understanding your risk tolerance and the fact that there are people who have extreme risk tolerance, even to the point that it's not just about their money. They're willing to take these risks with their lives. And that is like just a completely different place.
And how do you get to the place where you are on a slack line, 1,000 feet off the ground, intentionally on a wobbly thing where you can easily fall and have fallen before as you try to make your way from cliff to cliff? It doesn't happen quickly, right? And so what this documentary series does a good job of showing is the progression of, I'm going to take risk by putting myself to a harness and doing rock climbs. And also now there's drugs coming in. So it's a little bit more fun if you're rock climbing and smoking pot for this group. Then what can we do to get even more of an adrenaline rush? How about base jumping? Which is, we've done skydiving and that's fun, but I really like jumping off the cliff. That's even more fun. Then I can add to that by saying, why don't I add my parachute to my back while I'm free solo climbing? Now there's the squirrel suits, so I can go flying, right? Now I can go even faster when I base jump and I can fly for 3 minutes instead of 30 seconds. And that's a great thrill. But Malcolm, that's not enough. And this is where we will end this, which is that not only am I getting enough thrill from the squirrel suit flying going away from the cliff, I need to do squirrel suit flying close to the cliff, which is called proximity flying, because I can get a better rush when I see the trees going by quickly right next to my face. And so
until everything goes black.
So the point of this though is like, it doesn't go from 0 to 1. And when you see these extreme examples, that happens a little bit in investing as well, in the way people manage their money, where you start doing a little bit of leverage, then there's a lot of bit of leverage. And then even in gambling, the stat I want to do, and then I will shut up, I promise, is that for a company like DraftKings, the reason they are making more money is because their average revenue per monthly active user goes up. Not just getting new customers. So it's like once you start gambling a little bit, their average revenue was up 21% for the past quarter compared to last year. So that to me says that it's, once you get in, you start taking risk. If you're not careful with it, the way you get the feeling is you take more and more risk.
Well, I mean, it says something that those companies also do really well when the economy is bad.
Yeah,
like
fair.
When people feel bad about what's going on around them financially, that's when the desperation you're talking about sets in even more, and people start literally gambling their rent money. So I don't know that I want to be lining up on the side of a DraftKings or FanDuel as a shareholder. But what I think, too, is important to point out in what you were talking about is that so I did watch the Free Solo documentary. And one of the things that was interesting to me and is very relevant to this is the fact that I can't even remember this guy's name.
Alex Honnold.
Thank you. So that guy was saying that he realized very early on in his climbing career that he doesn't have the same part of his brain that most people have that starts screaming and shouting really loud and waving your hands and saying, hey, danger, danger, something's wrong here, get me down. So when normal people get 6 or 10 or 20 feet off the ground, they go, all right, that's enough. This was fun. Or like you said, they start taking drugs. They start doing other things to help themselves numb that part of your brain that says danger, danger. In his case, he doesn't really have that. And he realized early on that he doesn't have it. And the reason I say that's relevant to the investing conversation, the tie-in that you're making, is because this is the reason why you have to play your own game and not focus on what everybody else is doing. Because what you don't realize is that guy over there has a superpower that you can't see, right? Like his medulla oblongata or whatever being different than yours makes him perfectly situated to be a free solo climber who could care less about falling. You don't have that. Or the guy who's able to blow up a $20 billion hedge fund because he's using leverage on leverage on leverage. We don't know who his financial backers are and what family he comes from that might be funding this whole thing that put a safety net under him that you can't see. So we're following along with that and trying to do our best to impersonate it, not realizing that we don't have the same distance to fall.
Yeah. With Alex Honnold, somewhat of a distraction that I will take it back to risk. There's a part in Free Solo where I think he handled a very personal financial question better than just about anyone I've seen, where he's doing a classroom talk. And one of the kids asks, like, you're a elite rock climber, just how much money do you make? And there's some chuckles and it's like a pretty personal question. And Alex Honnold responds saying, like, I make about as much as a moderately successful orthodontist or dentist. So I was like, that's actually incredibly smart, because he's like, I'm not going to give you a number, but I am going to put it in context and also kind of highlight the fact that I am basically the very best at my sport. And it doesn't necessarily make you a billionaire. Mm-hmm. And so I was like, as a financial thing, I was like, I thought you handled that personal question, which can go like, oh, that's personal, I don't want to tell you. It can go grandiose. I thought he handled it in a very like, I'm going to answer your question with context, but also not like tell you everything.
It also tells you he does it somewhat for the love of the game.
Yeah. Do you think you're climbing up a cliff face without a rope just because of money?
People do some very interesting things for money.
Okay, fair enough. Last part I'm going to talk about with this is from my education is I think financial advisors in the financial industry often asks people, what is your risk tolerance? Right? Let's do a risk tolerance questionnaire. And in some ways that serves the client. It also serves the advisor quite a bit, which is that, hey, we need to make sure you're comfortable. The thing people don't want to tell people as much is what is your risk capacity? And that is the level of risk you can and should take. And the reason is it's like, if you're an advisor, this is the medicine you actually should take. This is the amount of risk you, given your situation, you are capable of taking. However, if we go to 100% what is correct on this, and then we get a bear market, you're going to get pissed and then maybe go somewhere else.
I think people are way more likely to get pissed because a bull market happened and they got left behind than the other way around, believe it or not. I'm saying this with limited experience because I came into the business right after the great financial crisis and we haven't had anything as significant since then. But I think that what I am seeing is that we've shifted to a place where loss aversion is the focus so much as FOMO is the focus. And I don't want my dentist or orthodontist to do better than me in the market for too long. And that is a reason that I would leave, my financial professional behind.
Okay. Has anyone ever asked you what their risk capacity is?
No, but we talk about it. So
you got to bring it up.
To your point, yeah. Oh, for sure. I mean, it's one of those things that you don't necessarily know to ask about. You don't know that term if you're just like a person who isn't a finance nerd, a personal finance nerd. But we do the questionnaire to say, hey, how do you feel about risk? After asking you just in casual conversation, how do you feel about risk? And then compare your comments to the questionnaire and then talk about it in normal terms. So, I mean, in dollar terms. So if I've got $100,000 invested in the market today, if it falls to $90,000 over the course of a month, how do I feel? If it falls to 85,000, 75,000, 65,000, like how are we feeling in this moment? Because now I can actually see those real dollars and parts of my brain start to light up where they don't.
And there is a difference between seeing it on a questionnaire and actually seeing it. However, that's a story for another time. Let's wrap up with this chatbot and dating story. Because actually, first, do you want to apologize to Sam Altman? Because chatbots in and of themselves, OpenAI's ChatGPT crossed 1 billion global monthly active users. It was the fastest app ever to reach that milestone, including Google Maps, TikTok, Instagram, and YouTube.
I'm going to answer your question with a question.
If you
ordered something from Amazon and it made it to your house, but it made it to your house 7 months after you ordered it, do you owe Jeff Bezos an apology for blasting him publicly about it?
It was the fastest ever. Do I owe Jeff Bezos an apology?
Yeah, if you blasted him for saying, this thing is way later than you told me it was going to be, and so Amazon is not the best place to shop or the fastest place to shop, and then it shows up 7 months later, do you print a retraction?
Probably not. I wouldn't do that. I would never admit that I'm wrong, though. This is why I don't publish manifestos.
It is an impressive feat. Let me not discount like what they managed to pull off. However, it is also 7 months later than what we were told. So how impressed am I supposed to be at this point versus when you told me? Like if robo-taxis show up tomorrow, they're still 4 years later than when Elon Musk told us we would have them. So do we owe him an apology at that point?
He would like you to. I think we just, as a general rule on the show, we don't apologize to billionaires. unless you've like done something really wrong to them personally.
If they invite me onto their yachts to hang out for the week, I will apologize to them in person on the yacht.
We are available for advertisements and yacht parties. And also it's at a point now. So Claude, 56 million global active users, which is surprisingly low. Mm-hmm. However, that is a monthly active user growth of 640%. So that is the story on the street right now, which is that ChatGPT is kind of not on its way out, but it's not going to be the heavyweight champion compared to Claude.
So what's interesting is you're aligning yourself as a Claude guy. I am financially interested in Anthropic and Claude. Like I would invest in Anthropic. I would not invest in OpenAI at either IPO, but I only use ChatGPT. I've never used Claude.
You should use Claude. It's it is better for writing. Mm-hmm. It is a little meaner to you, which I think is good. ChatGPT kind of glazes its users a little bit too much. Like, you know, if you say you're doing something stupid, like that's not stupid. You're just tired. Claude's pretty good with reasoning. It's less good with any current information. Or it will also like, you know, there are times where it's like, hey, can you check on this? And they're like, hey, I don't know if that's correct. And you're like, okay, well then I need you to go look it up. And it's like, okay, yeah, I'm going to go do that now. So you're starting to see the token corner cutting a little bit with Claude. However, I think that it is a little bit more reasonable than ChatGPT, and Claude doesn't do the thing where it tries to be a BuzzFeed article at the end of every response, where ChatGPT, I'll ask, hey, I'm going to make some miso glazed carrots. Can you give me an easy recipe for that? Yes, here's the recipe. Now, if you really want to level up this recipe, do you want to know how to do it? If so, click yes to continue. Claude will just answer the question, which I appreciate. But anyway, where this is going, what are people using these bots for? It's for dating. And this is a good story in Bloomberg about chat phishing and people using AI-generated responses in order to attract partners. It's the point now where chat phishing has a 5,000% spike in Google searches from last summer. The problem, Malcolm, is that trying to write people on the internet to try to meet up with them and date them is difficult. So you just kind of input their responses into ChatGPT or Claude, get the output back, copy, paste, send it to your next romantic partner.
You know what occurred to me as I'm reading this? These people clearly didn't grow up in the age of AOL Instant Messenger or chat rooms, because you would have had 5 or 10 at-bats every day, every week of trying to figure out something clever to say to a stranger online. By now, as a grown-up, you'd have it figured out.
Yeah. Just, hey, that's a good picture. Do you like happy hours in the Denver area?
Yeah, like you'd have a better game than that by now. By the time Facebook came around, because Facebook came out right as I was going to college, so that tells you what generation specifically I'm talking about. By the time Facebook came around, it wasn't weird for a stranger to send you a message, you know, online that you had never met before. And so you knew how to engage in that way and then see that person on campus somewhere like 2 or 3 days later and pick up the conversation from there and still be the same you. In this article, they're talking about people that are like so interesting, writing 3-paragraph, you know, responses to people on the apps. And then you meet them in person and they got nothing to say, or they're not interesting at all. And like, that's fascinating to me, because you phoned it in so hard that your online self, you could never live up to who your online self was.
I loved this exchange in the article that they found from a Tinder user or Hinge user, where the woman says, "You figured out my secret. I do absolutely romanticize my life as a 90s rom-com." The guy says, "That honestly tracks. You definitely give off makes a playlist for every life moment energy. So what's your favorite 90s rom-com? Because now I'm judging the whole cinematic universe." Even in that paragraph, you can just tell that's ChatGPT. That is not a human writing that response.
Unless they are also somebody who is equally as into 90s rom-coms as you are.
This is not how people talk.
That is the way that people who are informed by rom-coms talk in your imagination.
Online dating is a hellscape from people I talk to on those apps. Tinder and Hinge are trying to get out of it with in-person events because they need to get more people to pay on their platform, which is always going to be a constant challenge. And now the strategy for Match Group is saying, let's be more than a hookup app. Let's do singles events in every major city. And in the major cities, trying to put them on at least once a week, which for a turnaround story, don't exactly hate.
Well, remember we were trying to save Dave & Buster's for the nostalgia of it all, basically.
I'm not done with that.
And I was saying that they needed to partner with, is it Barry Diller, I think, that owns all these companies that are now the Match Group, and work in their in-person events into the Dave & Buster's locations. And now we've got this cross-pollinization happening to the point where even as these people find each other, get married, and procreate, now instead of coming to singles night on Tuesdays, you come to family day on Saturday afternoon, and we still got you as a customer. And it's the circle of life. So
that's how Tinder wants to do it with double dates. How about that?
The funny thing, though, is that South Park predicted this whole thing years ago.
Yeah.
Like, I was watching a South Park episode where, what's the guy's name? I think Clyde is the one that's like writing, using ChatGPT to write text back to his girlfriend in class. Is this the
clip I sent you?
Probably, yeah. Yeah. So like he's 3 years ahead of the curve.
South Park, it's not The Simpsons predicted it. South Park predicted it. Wait,
there's a few things about AI that South Park did a whole show around, and we see it coming to fruition.
The point of the bit, by the way, is that Clyde's girlfriend, Bebe, loves getting texts from Clyde. They text all the time. Clyde hates it. And so he just copies and pastes whatever she says into ChatGPT, responds back. And she's like, oh, this is so wonderful to have such a supportive boyfriend. He reveals his secret to Stan, who hates texting. And his girlfriend, Wendy, wants more from him. That is the least funny way that I can do a South Park.
No, but the problem was he told everybody. So now everybody in the school knows about it. And they're all using it. And the girls find out and they're like, what the heck? So had he kept his mouth shut, he had a good thing going. And that might be the same thing that's applicable to these platforms, is like, had you kept your mouth shut and just,
When should you shut up is a good theme for a podcast in the future. Let's leave it there. Our email, thistimepod@gmail.com. You can find me on LinkedIn. I'm going to be doing some more posting on LinkedIn, hopefully. I'm going to be co-hosting The Indicator from Planet Money for the next 5 months. Meant to do that at the beginning of the show. I will say that at the end. So we'll have a little bit. I'll be working on that as well. Still doing this show is the plan. Still doing this show. And you can find me on social media, LinkedIn. I'll say that. Malcolm is @MalcolmOnMoney. I already said the email. Share it with a friend. Appreciate it. And we'll see you next week.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be, a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.